Assalamu alaikum. I am Mohammed. I hope you are all well. Today's topic is about exchange traded fund. Before starting the video, I request to all my friends to subscribe my channel and press the bell icon. Let's go to today's topic. We have different websites open. Let's take a look at one of them. Exchange traded fund when want the S of stock trading, but diversifications benefits of mutual funds. ETFs combine the best of both. Exchange traded funds are a type of investment that offer the best attributes of two popular assets. They have the diversifications benefits of mutual fund while making the S with which stocks are traded. What does ETF mean? An exchange traded fund or ETF is a basket of investments stocks or bonds. Exchange traded funds let you invest in lots of securities all at once. And ETFs often have a lower fees than other types of funds. ETFs are traded more easily too. But like any financial products, ETFs are not one size fits all solution. Evaluate them one on their own merits, including management costs and commission fees, if any, how easily you can buy or sell them, how they fit into your existence portfolio and their investment quality. How do of ETFs work? Exchange traded funds work like this. The fund providers owns the underlying assets, designs fund to track their performance, and then sells shares in that fund to investors. The shareholders own a portion of an ETF, but they don't own the underlying assets in the fund. Even so, investors in an ETF that tax stocks index may get a lump dividend payments or reinvestments. For the stocks that make up the index related, learn how to invest in index funds or compare index funds and ETFs. Well, ETFs are designed to track the value of an underlying assets or index, be it a commodity like gold or a basket of stocks such as the S&P 500. They trade at market determined prices that usually differ from that asset. What's more, because of things like expenses, a longer term return for an ETF will vary from those of its underlying assets. Here is the abbreviated version of how ETFs work. An ETF provider consider the universe of assets, including stocks, bonds, commodities, or currencies, and creates a basket of them with a unique ticker. Investors can buy a share of that basket just like buying shares of a company. Buyers and sellers trade the ETF throughout the day on exchange, much like a stock. Jump to learn how to start investing in ETFs. ETF pros investors have flocked to exchange traded because of their simplicity, relative cheapness, and access to a diversified product. Here are the pros. Diversification, it's easy to think of a diversification in the sense of the broad market vertical stocks, bonds, or a particular commodity. For example, ETFs also let investors diversify across horizontals like industries. It would take a lot of money and effort to buy all the components of a particular basket. But with the click of a button, an ETF delivers those benefits to your portfolio. Diversification can help safeguard your portfolio against market volatility. If you invested in just one industry and that industry had a really bad year, it's likely your portfolio would have performed poorly too. By investing across different industries, companies, sizes, geographies, and more, you give your portfolio more balance. Because ETFs are already well diversified, you don't have to worry about creating it within your portfolio. Transparency, anyone with internet access can search the price activity for a particular ETF on an exchange. In addition, funds holdings are disclosed each day to the public. Various that happens monthly or quarterly with mutual fund. This transparency allows you to keep a close eye on what you are invested in. Say you really don't want to be invested in oil, you to be able to support those additions to you or ETF more easily than with the mutual fund. Tax benefits, ETFs have two major tax advantages over mutual funds. If you invest in a mutual fund, you may have to pay capital gains taxes or the profits from the sale of an asset like a stock through the lifetime of your investment. This is because mutual funds, particularly those that are actively managed, often trade assets more frequently than ETFs. Most ETFs, on the other hand, only incur capital gains taxes when you go to sell the investment. This means you will pay less tax on your ETF's investment overall. As mutual fund managers are actively buying and selling investment and incurring capital gains taxes along the way, the investor may be exposed to both long-term and short-term capital gains tax. If you are invested in an ETF, you get to decide when to sell, making it easier to avoid those higher short-term capital gains tax rates. I hope you like the video. See you into our next video.